Welcome to the deep dive, where we unpack complex topics and get straight to the essential insights. Today, we're diving into something fascinating and often incredibly costly: overconfidence in the world of investing. Specifically, we're tackling the danger of thinking you're smarter than the market. We've pulled key ideas from foundational texts like Common Sense on Mutual Funds by John Bogle, and also the timeless wisdom of Benjamin Graham's The Intelligent Investor and Security Analysis. Our mission today is really to understand why believing you can outwit the market so often leads to pretty significant financial missteps, and just as importantly, what these legendary investors advise you do instead.
Yeah, and what's truly fascinating here is, well, just how consistent these warnings against overconfidence have been over decades. Even as markets change, technologies evolve, new investment products pop up. The core psychological biases, they stick around, and they interact with how markets are structured in surprisingly predictable, often costly ways.
Okay, so let's unpack that. This overconfidence, it often tempts us, right? It makes us
Mhm.
think we can outsmart the market's, well, it's irrational swings. Graham, though, he offers this really crucial distinction. It helps ground us back in reality. He argues a stock isn't just a ticker symbol flashing on a screen, it's actual ownership in
Yeah.
real business. But the market itself, that's something else entirely. Could you elaborate on that difference? Why is getting that distinction so critical?
That's absolutely the place to start. Graham really wants us to see that a stock's true value, its intrinsic value, comes from the underlying business. Its earnings, its assets, its actual ability to generate profit over time. That's investing. But the market, his famous Mr. Market analogy, that's more like an emotional pendulum. It's always swinging back and forth between, as he put it, unsustainable optimism, where prices get way ahead of themselves, and unjustified pessimism, where fear makes everything look cheap. The intelligent investor, Graham says, acts like a business owner. They use these emotional swings. Sell to the wild optimists when prices are inflated. Buy from the fearful pessimists when good businesses are on sale.
Right. So connecting that to the bigger picture, then, Graham explicitly says investment is rooted in those fundamentals: earnings, dividends, the actual business performance. But speculation, that's driven by something much more fleeting: changes in the price earnings ratio, basically what other people are willing to pay for those earnings.
Exactly. It's about perception, not necessarily reality. This speculative element, it's incredibly powerful in the short run. It can create these dramatic price surges or collapses, but they're often temporary. It's driven by the shifting mood of the crowd, not a fundamental change in the business's value. And that's what fuels overconfidence, this belief that I can predict the crowd's next mood swing.
And we've seen this play out again and again, haven't we? Through what our sources call these trendy formulas that, well, they always seem to fall flat eventually. Remember the January effect? That idea, it was even in academic papers back in the 80s, suggesting you could just buy small stocks late in the year and reliably make big gains early in the next.
hmm
Or the whole new economy bubble in the late 90s. Tech stocks, especially Amazon.com, Qualcomm. Their stocks just soared based on these frankly impossible sounding forecasts, only to crash later. The sources mention Amazon jumping 19% in one day, hitting over $400 in 3 weeks, just based on one analyst's forecast. Qualcomm was up, what, 1,842% in a year? Then another 31% jump in a day on another prediction. It sounds crazy now.
But people believed it. And then later, you saw the same kind of speculative frenzy with things like collateralized debt obligations, CDOs, these complex bundles of loans. They were central to the 2008 financial crisis. This just shows the pattern repeats. New instruments, maybe, but the same underlying driver.
Hmm.
Human overconfidence thinking this time it's different.
Which really begs the question, why do we keep falling for it? Why this pattern of speculation over sound investment? John Bogle, the Vanguard founder, he points directly at investors themselves. He says mutual fund investors show these consistently counterproductive investment patterns. They adopt this short-term view, often driven precisely by that overconfidence we're talking about.
Precisely. And the data shows this dramatic shift. Back in the 60s and 70s, holding a mutual fund for, say, 12 or 13 years was normal, real long-term investing. But by the late 90s, our sources show the average holding period plummeted to just 3 years, an annual turnover rate of 31%. That's not investing. That's frantic activity. It's churning. It's a rush to act, chasing recent returns, believing you know where to jump next. It works directly against building long-term wealth.
And incredibly, it wasn't just individual investors doing this. The sources point out that fund managers themselves, people with a fiduciary duty to act in clients' best interests, they became short-term speculators. Portfolio turnover for the average U.S. equity fund hit 85% in 1997. That means they're holding stocks for barely more than a year.
Think about that.
This rapid-fire trading, it burdens you, the investor, with huge transaction costs and taxes. It makes it incredibly hard for even the managers to generate good long-term returns, let alone for you to benefit.
Graham just cuts right through it. He says investing based on projection, trying to forecast the future, like those crazy tech stock calls, is simply a fool's errand. He argued pretty forcefully that forecasts, even from supposed experts, are often less reliable than the flip of a coin. Real investment success, he suggested, comes from protection. Protecting yourself from overpaying for something, yes, but also, crucially, protecting yourself from your own overconfidence. It demands a disciplined, almost defensive approach, respecting that markets are unpredictable.
Okay, this is where it gets really interesting and hits the core of that overconfidence problem. Why is it so incredibly hard to consistently beat the market? Our sources highlight a few key reasons, things often ignored by people who think they have some special edge. The first one, maybe the biggest, cost. It's like the silent drag on everything.
Indeed, costs matter profoundly, and they're often way more than people think. You have the obvious ones, the stated expense ratios, maybe 0.2% for a cheap index fund, maybe up to 2.2% or more for an active one. But then you've got the hidden costs, portfolio transaction costs, all that buying and selling from high turnover, averaging maybe 80%, that can easily add another 0.5%, even a full percentage point every year.
Wow.
And then things like 12b1 fees used for marketing, averaging 0.40% back then for many funds, billions of dollars annually, plus other undisclosed fees sometimes used for distribution, not managing your money. It adds up fast.
So you're saying if an average equity fund has, say, a 1.5% expense ratio plus another 2% in those hidden trading costs,
Right.
it has to outperform the market by 3.5 percentage points before any fees just to break even after fees.
Exactly. That aggregate fiscal drag, as Bogle termed it, it can eat up almost a third of a decent 10% annual market return.
It's that tyranny of compounding Bogle talks about, but working against you. These seemingly small percentage points year after year, they create absolutely staggering differences in how much wealth you actually accumulate over time.
It's huge.
It's like an invisible tax on your future.
Yeah, and this points to a potential structural issue in the industry itself, right? Most fund management companies exist to make a profit. When that profit motive clashes with their fiduciary duty to you, the investor, the sources bluntly state, greed wins and profits triumph. They cite Vanguard and TIACRE as notable exceptions operating without that inherent conflict. This often means the focus shifts to marketing, gathering assets, charging fees, not necessarily maximizing your actual return.
Yes.
It just makes the cost problem worse.
Okay, so cost is a massive hurdle. What's another key factor making beating the market so tough, especially for the overconfident investor?
It's this powerful concept called reversion to the mean, described as almost a first principle of financial physics.
Right. The idea that superior performance, whether it's a star fund manager or a hot market sector, it doesn't last forever. It eventually gravitates back towards the average, the long-term norm,
Okay.
financial gravity.
Think of a rubber band. You
Yeah.
can stretch it really far, but eventually
Yeah.
it wants to snap back to its normal state. It's the same with investment returns. Exceptional performance is, well, exceptional. It's hard to sustain.
Which leads to this really stark conclusion from the sources. There is no evidence, none, that superior past performance is predictive of future success. That completely undermines the whole idea of just picking last year's winner, which is a classic overconfidence trap.
Absolutely.
Yeah.
Look at Legg Mason Value Trust, an incredible run, beat the S&P 500 for 15 straight years, 1991 to 2005. You'd think they cracked the code, right? But then, 2006 to 2008, they lagged the index by an astonishing 43 percentage points. Reversion hit hard. The sources also show that around 73% of the top-performing general equity funds from the 1990s, in the following decade, they drifted back towards or even below the S&P 500 average. Even broad categories like U.S. stocks versus international stocks, over a very long period, 1959 to 2009, they showed almost identical compound returns, around 11.5%. It demonstrates this powerful pullback to the average.
So those star systems, like Morningstar's 5-star ratings that everyone looks at, they have little predictive value. In fact, the research showed that if you actually bought funds when they got 5 stars and sold them when they lost that rating, you ended up with below-market returns and above-market risk.
Precisely the opposite of what you'd intuitively, perhaps overconfidently expect.
Okay, so if actively trying to beat the market, driven by overconfidence, is so often counterproductive due to costs and reversion to the mean, what's the smarter path? Our sources keep coming back to one word: simplicity. It sounds almost too easy, doesn't it? But one source puts it beautifully. The secret of investing is, finally, that there is no secret. It's about embracing basic, proven principles.
Yeah, the core wisdom from both Graham and Bogle is remarkably straightforward, and it's really the antidote to overconfidence. First, invest you must. You have to be in the market because, over the long haul, time is your friend. Mm. Starting early, even small amounts, lets the miracle of compounding work for you. Conversely, impulse is your enemy. You have to take emotion out of it, have rational expectations, and critically, avoid changing those expectations as the seasons change, as market sentiment shifts. It's about discipline, not prediction.
And that leads directly to advocating for index funds, doesn't it? Vanguard, Bogle's company, launched the first one back in 1975. At the time, it was widely mocked. Bogle's folly, they called it. People thought it was crazy not to try and beat the market with active management genius.
Right.
But now, figures like Peter Lynch, a legendary stock picker, Charles Schwab, even the Motley Fool, they all acknowledge the benefits. Lynch famously said most investors would be better off in an index fund. Coming from him, that's powerful.
And the data just backs it up overwhelmingly. Index funds have much lower cost than 0.2% expense ratio versus maybe 1.8% or more for active peers. That's a huge head start every single year. They're also incredibly tax efficient because they trade so little. Low turnover means fewer realized capital gains you have to pay taxes on. Over 15 years, they were shown to beat 97% of active funds purely on an after-tax basis. And crucially, they carry substantially lower risks. Morningstar data showed their risk scores were over 30% lower than active funds recently. So you pay less, keep more after taxes, and take less risk, all by admitting you can't consistently outsmart the market.
The long-term impact on your actual money is just staggering. That example, $10,000 invested from 1982 to 2009 in a low-cost all-market index fund. It grew to $153,100, captured 97% of the market's growth. The average actively managed fund, only $113,700, capturing just 70% of the growth. That's nearly $40,000 left on the table from a single $10,000 investment, mostly due to cost and underperformance.
And even using a more modest market return assumption, say 8% a year. Over 15 years, that $10,000 in an index fund grows to about $30,900. The active fund, losing ground to costs. Maybe $24,000. That's almost $7,000 difference just from choosing the simple, humble approach. It's not about settling for average. It's about maximizing your probability of achieving the market's return, which is usually better than what active management delivers after costs.
So beyond just buying an index fund, what other simple disciplined behaviors flow from this, from accepting you're probably not smarter than the market?
Well, it's about having a plan and sticking to it. Things like dollar cost averaging, investing a fixed amount regularly, no matter what the market's doing. It takes the guesswork, the overconfident market timing right out of the equation. Rebalancing is key, too. Periodically bringing your portfolio back to your target mix of stocks and bonds. It forces you, systematically, to buy low and sell high without trying to predict anything. And maybe the hardest part, ignoring the noise, the constant headlines, the daily gyrations, the endless predictions from experts, just trusting the long-term process. As Graham and Bogle both essentially said, never think you know more than the market. No one does.
So you see this danger of overconfidence. It isn't just some abstract psychological concept. It has real, tangible, often very large financial consequences for you. The core lesson from these investment giants, Bogle and Graham, it's surprisingly simple, really. Embrace humility, understand that tyranny of costs, and trust the power of the overall market more than the allure of supposed individual genius.
Which leaves us with a crucial question for you, the listener, to think about. We live in a world that constantly pushes the idea of beating the market, right? Celebrates the latest star manager or hot stock picker. How will you personally resist that powerful temptation of overconfidence? How will you embrace the simple, evidence-backed approach instead? What really stood out to you in today's deep dive?
We really hope this deep dive into the pitfalls of overconfidence helps you navigate the financial markets with, well, a bit more clarity and certainly a healthy dose of humility. That's often the key to genuine, long-term financial success.